What's going on, guys, and welcome back to another video. So in today's video we're going to be looking at Facebook, and more specifically why I believe that Facebook is vastly undervalued compared to its peers. And when I say its peers, I'm talking about the other big four tech companies being Apple, Microsoft, Google and Amazon. So we're going to focus on the fundamentals of the business, looking at both the historical financial performance as well as what we can expect from the business in the future. And then we're going to use those assumptions to develop what we believe is the intrinsic value of the company using discounted cash flow and earnings multiple model. But most importantly, I just want to show you why the numbers suggest that despite the incredible run-up that Facebook has been on recently, being up 40% year to date, this company is still vastly undervalued compared to the rest of the big tech companies. But just before we jumped into the numbers of Facebook, I wanted to show you this chart here. Now this is a chart that you may have seen on some other YouTube videos, but effectively it shows you the forward PE ratio of the S&P 500, and we can see that we're sitting at 21. And when you look historically, we're effectively higher now than we have been over the last 20 years on a forward PE ratio basis, with a lot of people using this to demonstrate why the market may be overvalued, particularly with reference to the mid caps, which has a forward PE ratio of 16, and the small caps, which have a forward PE ratio of 15. And there might be some merit to that, but really why I'm showing this chart is just to emphasize the point that whilst the market, the S&P 500 as a whole, may be overvalued, there are still many companies within which are actually undervalued, and that's what we're going to get into today. Now, I'm sure the majority of you know, but the S&P 500 is made up of 500 companies, and the top 5 companies within the S&P 500 actually accounts for 20% of the total market capitalization. So any large moves within the top 5 companies usually results in a large swing in the S&P 500 as a whole. So those 5 companies are Apple, Microsoft, Google, Amazon and Facebook. So the general suggestion is that if the S&P 500 is overvalued, then certainly the top 5 companies within the S&P 500 are also overvalued by virtue of the fact that they make up a significant portion of the S&P 500. Facebook, however, I don't think should be included within that. Actually, just before we get any further into the video, I just want to disclose that I am not a shareholder of Facebook, which may raise the question, if I believe that the company is so undervalued, then why do I not own shares in the stock? And that's a valid question. And the answer to that is because due to the financial services firm that I work for, there are some restrictions to stocks that I can hold, and Facebook just so happens to be one of them. So that is the only reason why I don't hold Facebook. I'm simply not allowed to. Anyway, with that out of the way, we'll continue on with the video. So just before we dive into all of the numbers of Facebook, I just wanted to show you this from the most recent quarterly results. So this chart here shows family daily active people, which is effectively people that are signing into one of Facebook's platforms, whether that be Facebook itself, WhatsApp, Instagram or Messenger, every single day. And you can see here that in the latest quarter, 2.76 billion people logged into one of Facebook's apps at least once in the day, which is absolutely mind-blowing, right? So more than 1/3 of the entire world is logging into Facebook. And bear in mind that not everybody has access to internet as well. So in terms of the number of people that actually have access to the internet, or the proportion of people, that percentage goes from 1/3, probably somewhere closer to around 50%. So 1 in 2 people that actually have access to the internet are logging into one of Facebook's platforms, which is absolutely incredible. It does also show you that there is still increased scope for growth, just due to the fact that when more people gain access to the internet, which we know is happening all the time, then this figure is expected to grow as well. But 2.76 billion people every single day are logging into one of Facebook's apps, which is absolutely mind-blowing. Anyway, on to a few key highlights of their most recent quarterly results, right? So total revenue was up 56%, right? So for a company, if this is a $1 trillion company, to be growing its revenues at 56% is absolutely unbelievable. So that is huge growth in their revenues. And then their net income actually grew by 100%. So they doubled their net income. They increased their revenues by 56%. From a financial point of view, we'll dig into the financials a little bit more, but Facebook is absolutely unbelievable. Now, when we flick over to Facebook's balance sheet, it really doesn't get much better than this, right? So they've got $62 billion in cash and marketable securities. Now, marketable securities are highly liquid assets. Effectively, you can count them as cash. So they've got $62 billion in cash. And in terms of debt, well, in the strict sense of the word, they don't have any, right? Now, I like to include operating leases as debt because they are interest bearing. So from my point of view, they've got $1 billion in their current and they've got $11 billion in their non-current. So effectively, they've got $12 billion of debt even though it's not necessarily debt per se, but for my valuation purposes, I call it debt, right? So $12 billion of debt, $62 billion of cash. If we look at that cash balance, right, so they've got $62 billion. If we look at their total liabilities, it's $32 billion. So they could use that cash and pay down all of their liabilities, and they would still have $30 billion of cash left over to do with whatever they wished. So their balance sheet is absolutely fantastic. Now that brings us on to the comparisons between Facebook and the other big tech companies. So what we've got here is revenue year over year historically, and also what the estimates are going forward. We've got EBITDA margin, we've got unlevered free cash flow margin, and we've got enterprise value to EBITDA multiple, right? And I've taken all of these values from Ticker Terminal. Now this is a really great interface. I absolutely love Ticker Terminal. So for you guys that haven't used it before, I would definitely recommend checking it out. Needless to say, I'm not affiliated or sponsored by them or whatever. I mean, I've got 500 subscribers, so I don't really think that that is a risk, but I just thought that I'd put that out there anyway. So if we start with revenue growth, so in 2016, they generated $28 billion in revenue. And in 2022, they're expecting to generate $142 billion in revenue. That's a compounded annual growth rate of 31%. Now that is by far the highest out of all of the big 5 tech companies. And so they get a first place medal there. If we move on to EBITDA margin, they are also ranked first. So it's been around between sort of 46 and 57. The last 12 months was 50. Either way, they are ranked first on their EBITDA margin. So they are very profitable. They convert a lot of that revenue into EBITDA, which is fantastic. Similarly, for unlevered free cash flow, they actually rank third here. So in terms of the last 12 months, it was a 22% margin, and Microsoft was better at 26%, and Apple was better, slightly better than Facebook at 24%. But you can see that they're not too far behind in terms of their margins on the free cash flow. So we've got first place on revenue growth, first place on EBITDA margin, third place on unlevered free cash flow margin, and then in terms of valuation, so this is next 12 months. So effectively, we are taking what the enterprise value is today and dividing that by what the EBITDA is going to be a year from now, and then we get a multiple. So Facebook is actually the lowest multiple, which means that they are the cheapest. So they get a first place there. So on all of these key metrics, right, with exception to unlevered free cash flow, Facebook is coming out on top, right? So that's very good to see. They are sort of growing the fastest. They are the most profitable in terms of how much of their revenue do they actually convert to EBITDA. And also they are the cheapest from a valuation perspective. So the combination of those things, usually they don't really add up, right? So this is why I think that Facebook is so vastly undervalued. So then that brings us on to what I believe the intrinsic value of the company is based on my discounted cash flow and earnings multiple model. So I'll run you through each of the inputs here, right? So for 2 to 5 year revenue growth, I've gone with 18%. Now you might notice that that's not 1 to 5 year revenue growth. And the reason for that is because we are already halfway through the year and we already have 2 quarters worth of results. And in the last quarter, they posted revenues of $30 billion. And the quarter before that, it was slightly under that. So if you scale that up, $120 billion for 2021 seems about right. And actually, I've taken that value from analyst estimates as well. So it's not like it's a figure that I've just plucked out of the air. That is what analysts are expecting. And given the last 2 quarters, it seems reasonable to me. So $119 billion for FY21, and that's revenue growth of 39% for the entire year. Very, very strong result. Now for 2 to 5 year revenue growth, I've gone with 18%, right? So that puts us at $141 billion of revenue for FY22. And actually, if we flick across to Ticker Terminal, analysts are expecting $142 billion for that year as well. So that makes a lot of sense. And actually, if we flick across to the growth estimates, according to the analysts on Yahoo Finance, we'll scroll down to the bottom here and we can see that for the next 5 years, they're expecting growth of 28.6% in their earnings. So 18% in their revenue seems fairly conservative in my opinion, but this just really goes to show you how undervalued the company is when we come on to the valuation or what we believe the intrinsic value of the company is. For 6 to 10 year revenue growth, I've gone with 15%. Effectively, we're expecting a little bit of a slowdown in the revenue growth as the size of the company gets larger and larger. And that's just the law of numbers and that's how things work, right? However, they are growing so quickly that I don't expect a massive drop off. I think 15% revenue growth for year 6 to 10 is probably fair. In terms of gross margin, we've gone with 80%. So you can see here that there's a decline in their gross margins sort of year over year. 2021 is actually expected to be sort of higher gross margins than what we've seen here, but just to remain conservative, I've gone with gross margins of 80%. Now, in terms of operating expenses as a percentage of revenue, I've actually gone with 40%, right? And there's a reason for that. So if we actually look across here, the average is 41%. However, when we look to their financial results, we can actually see that operating expenses over the last few quarters have actually been declining. So for the quarter just gone, so Q2 2021, these are the operating expenses here, and these are the cost of sales. So cost of sales is taken into consideration within gross margin. So we're just focused on these three highlights here, right? So we've got 21 plus 11 plus 7. So that's operating expenses of 39%. If we look to the quarter prior to that, that was 37%. Now, I've used 40% in my expectation going forward. Again, I think that that's conservative but fair. Now, for free cash flow as a percentage of revenue, I've gone with 25%, which is effectively just the average of the last 5 years. There was a drop off in 2020, but we've seen a uptick in the first 2 quarters of 2021. And I think that 25% is a fair representation of what the company can expect going forward. For terminal growth, I've gone with 2.5%. And for the weighted average cost of capital, we've actually got 9.8%, and that's because the company doesn't have any debt, which is generally a cheaper form of raising capital. Well, it's almost always a cheaper form of raising capital. So they actually have a relatively high weighted average cost of capital. Anyway, that just means that we're discounting the future cash flows by a greater amount, which is really only beneficial for the shareholders. So that's good. Cash and cash equivalents, as we were speaking of earlier, around 64 billion. And then debt of 12 billion, which is just the operating leases that I was referring to earlier on. And so according to those inputs, using the discounted cash flow model, we get an intrinsic value per share of $385. And according to the earnings multiple model, which is based on a PE ratio of 20 in 10 years time, then we get a sort of a share price in 10 years time of $1,100. When we discount that back to today using the weighted average cost of capital, we get an intrinsic value today of $445. Take the average of the two, and we're looking at an average estimated intrinsic value of $415. So the earnings multiple model suggests that in 10 years time, a Facebook share may be worth $1,100. For those of you that like a slightly shorter time horizon, I've used an enterprise value to EBITDA multiple. And if we flick across here, so my price target for 2025 is based on revenues of $232 billion, which actually just pulls in from our analysis that we've just run through. An EBITDA margin of 50%. And again, if we just flick across to the comparisons, we can see that the EBITDA margins have been as high as 57%, as low as 46%, and the last 12 months have been 50%. Now, I believe that they can maintain 50% going forward, and so that's what I've used. That would give us a 2025 EBITDA of $116 billion. And I've applied an enterprise value to EBITDA multiple of 18. Now, in terms of how I've come up with that enterprise value to EBITDA multiple to apply for my valuation, I've used the average of the last 3 years. So you can see here that the average over the last 3 years has been 18. We've seen highs of 24, lows of 11, and we're currently sitting at around 19. So my 2025 price target is actually accounting for a slight compression in the earnings multiple in which an investor will be willing to pay. So currently it's 19. I'm saying that in 4.5 years time, sort of investors will be willing to pay a multiple of 18. That would give us an enterprise value in 2025 of just over $2 trillion and a price target of $758. Now that would be a compounded annual growth rate of 16%, which again, as I always say, anything above 15%, you're doing very well. The S&P 500 is historically done around 8 to 9%. So if you achieve 16% compounded annual growth rate for the rest of your life, you'll retire very, very happy. So that is why I believe that Facebook is so undervalued, especially compared to the other big tech companies. And yeah, I don't hold a position for reasons which I've explained earlier on. But if those reasons were not in the way, then I would definitely have this stock in my portfolio. Anyway, guys, I hope you've enjoyed the video. And until next time, thank you.